Welcome back. You're watching The Money Show on ET Now. Well, a status quo by the RBI on interest rates means, well, good news for borrowers because they get to enjoy those rock bottom rates for a little while longer. But not so great news for those individuals who've been relying for a very long time on fixed income and more particularly FD investors. So we'll talk about this for both sides of stakeholders. I have with me Adil Shetty, the CEO and co-founder of bankbazaar.com. Adil, it's great having you back with us on The Money Show. Hope you and the team at Bank Bazaar have been keeping well amidst these tough times. So to start with, Adil, the fact that it's been the sixth straight time that the RBI, the governor, has decided to keep interest rates unchanged at those extremely low levels of 4% means that FD investors now have to bear with those low interest rates for longer. But the question is there any, what are the instruments available out there which could perhaps help investors make the best of this scenario or maybe enhance returns as well?
Great question, Mubina. So let's answer this in two parts. So let's start with what is the situation right now for a fixed deposit holder. So I was checking on the fixed deposit rate of various banks, small finance banks and Bank Bazaar before the show. And here's where things currently stand. So for deposits, fixed deposits between 6 months and 1 year, most large banks are giving an interest rate of about 4.4%. Now you do for more than 1 year to 2 years, you make about 5%. You do this above 5 years, you make about 5%. So let's start with up to 1 year, right? 6 months to 1 year, this is 4.4%. Now we're paying 30% tax on the interest being earned. So net on that fixed deposit, you're only taking home 3% post-tax. So yes, you're right. It's a difficult situation for fixed deposit holders out there. One thing I should call out, right, is a lot of senior citizens use fixed deposits. So my parents use fixed deposits and they typically get 0.5% more. So it is a tough situation. 6 consecutive times the MPC has kept the repo rate flat and up to 1 year, you're at 4.4%. Now let's come to part 2 of your question. So what are the other options out there if I'm looking for safety and I want safe fixed deposit, liquid mutual fund kind of instruments out there? Now, I'm going to list out 3 options and I'm going to tell you what the returns are. But at the end of the day, each of these options, right, comes with its own cost. So option number 1, if you take a fixed deposit with a longer tenor, there's a slightly higher interest rate being offered. So we said if it's above 5 years, you can get 5.5% compared to the 4.4% you're getting from 6 months to 1 year. This is option number 1, but the downside is you lock in your capital for a longer period of time. And if interest rates start to go up, you're still locked in because you can't break out of the FD without a penalty. Option number 2, while the large banks are offering 4.4% on a 1-year FD, the smaller banks are offering 1% more because it's a competitive environment. The small finance banks are offering 2% more. Should you consider it? Depends, right? Because there's slightly more risk that you're taking on in order to take that higher return. You need to decide the trade-off. Lastly, the speaker before me spoke very well, right? Liquid mutual fund, debt mutual fund. Yes, there's a little more risk, but if you hold a debt mutual fund for 3 years, it doesn't get taxed as income at 30%. Instead, it gets taxed as long-term capital gains, which is closer to 10%. So there is a benefit in terms of the tax treatment of the debt mutual fund, and liquid mutual fund are the lowest risk form of debt mutual fund you can take. So I know this was a long answer, but these are the options out there today.
No, absolutely. And I'm glad you encapsulated everything in that. So 5-year FD, small bank FD, debt MFs, yes, they do give you that few 1-2% extra, but it comes obviously with terms and conditions. A 5-year FD, you're obviously locking yourself in for a long time. So even if, let's say, few months later, the governor decides that, okay, inflation is a problem, so I want to hike interest rates, you are stuck in that 5-year FD. Small bank FDs, again, you get that 2% odd extra, but again, it's a small bank, right? So you if anything happens and if anything goes belly up, you'll have to resort to the DICGC's 5 lakh rupee insurance. Debt MFs, it's again market linked, so they do carry their own market linked risks. So I guess for now, like Adil said, it's a trade-off really on what suits you and what doesn't suit you if you're willing to take on that extra risk. Now, Adil, my question is that given the fact that interest rates are so low, and I don't think we've ever seen interest rates for fixed deposits being so low. I know you mentioned a 5-year FD tenure is a good option, but even then, the extra interest that I'm getting is just 1% odd. Don't you think that after maybe even 2 years, the situation will be radically different? And it makes sense that right now, given the fact that interest rates are very low, I stick to shorter term FDs?
You make a reasonable argument, Mubina. So let's start with the facts as we know them, right? FD between 6 months and a year currently at a large bank gets 4.4%. A 5-year FD, on the other hand, gets 5.4%. But like you rightly pointed out, if I lock in for a 5-year FD now, let's say a year from now, the interest rate goes up, FD rates go, from 5 to 6%. I'm still locked in for 5 years. The minute I break that FD, right, I pay a penalty. So I don't even get the 5.4. I get a penalty and I have to break it, which is not the ideal circumstance. To be completely honest, right, no one knows how the future will unfold. So 2 years from now, will the 1-year FD rates be 4.4? Will they be 6.4? Frankly, no one knows. I think in this COVID kind of environment, right, no one knows what things are going to look like 3 months from now. But you're right, it's a 1% delta. It might make sense, right? Especially if you're a senior citizen. You get that 4.4, then you get the 0.5%. Stick to the 1-year FD if you don't want to take any more risk. And let's see how the situation is 1 year from now. If you're okay with a liquid mutual fund, right, that gives you extreme flexibility. So you can go in, you can go out. There is a tax benefit to it. So I think these are some of the choices out there.
Oh, yeah, absolutely. I mean, things are so dynamic on account of COVID. In Jan, we were looking at 1.5 lakh total active cases in the country. Today, we are adding 1.5 lakh cases every day. In just a 4-5 month period, things have changed so dramatically. So I suppose all the more it begets that question. Now, again, in January, we had seen SBI, HDFC hike their fixed deposit rate, something that we've not seen them do in a very, very long time. Do you think that this trend of sorts would continue, that this is the cap, the floor of sorts rather for FD rates, that you don't see them going any further lower?
Yeah, so we saw SBI and HDFC increase their FD rates, and these are the bellwethers in the market. One typically expects that when they do increase, the rest of the market will follow. However, what we saw, right, is there's no clear trend right now. So it didn't happen across the board. I think because the RBI has kept the repo rate flat at 4%, we've not seen a clear trend either way. I think we're fairly clear that this is probably as low as what FD rates will go. So I think people can probably rest assured that they're not going to earn less than what they're earning today. But in terms of when the movement upward is going to happen, I think the sense is it will happen. I think the speaker before me spoke about the fact that the government is borrowing significant amounts of money. There is a sense that given that SBI and HDFC raised, that the others will raise, but that clear trend has not appeared right now. That being said, right, we still see a delta between categories of fixed deposit issuers. So like we were discussing previously, while the large banks are offering 4.4% for up to 1 year, some of the smaller banks are offering 1% more. Some of the small finance banks are offering 2% more. In fact, in the small finance bank side, we're seeing a range for an FD of up to 1 year between 6.5% and 7.25%. But as always, right, the return comes with that additional risk that the fixed deposit taker signs up for.
All right. This is a product that, frankly, even I didn't know until a few months ago, but it does exist, and that's floating rate deposits. Quite a few banks offer it. Adil, when we think of deposits, we usually just stick to the usual recurring or fixed deposits. What's your opinion of floating rate deposits? And considering that you believe that this is as low as it can go, and maybe it's only up from here, do you think that could be a good option, floating rate deposits?
Yeah, so Mubina, you bring up an interesting product, and to be completely honest, you're in the industry, so am I. I also had not heard too much about this product. I think a few banks offer it. It's one of these new kinds of products. I think one needs to look at what is the floating rate interest being offered, what is the post-tax take-home, and does it make sense to me? What I find with some of these products, right, is the popularity is not that high. So, for example, people talk about fixed rate home loan, right? Because everyone knows about floating rate. But fixed rate home loan are actually less than 5% of the market. They're not taken often. When you ask me the question, right, and I checked as to what exactly is happening with banks today on Bank Bazaar, what I actually found that a popular product similar to what you just said is a high yield savings account. So there are savings account out there, right, which gives 6% return on a savings account, which is go in and go out on a daily basis. I think the one thing I've realized, right, because I used to hold one of these high yield savings account, is that it can change dynamically. So a bank can decide that as of March 31st, I'm not going to offer you 6%, I'm going to offer you 4%. And things can change because that's part of the terms and conditions on the product. And then you need to decide saying, okay, I opened a savings account. Do I need to retain it? Now that the rate has come down, or do I need to move somewhere else? So in terms of this floating rate fixed deposit you spoke about, I think one really needs to understand what is it being offered, how is it reset, what is my post-tax return, and then you decide. The closest I've seen, which is popular, is a high yield savings account. But what you need to keep in mind is today's 6% could change, it could continue. So just keep a watch on it. And if it does change, be ready to rebalance your savings in a way that suits your long-term goals.
All right, Adil, I just have a few more minutes, but I definitely want to ask you on the loan side. Many banks have been offering COVID-19 loans as well to pay for treatments, etc. PSU banks have been offering personal loans of up to 5 lakh rupees. When, according to you, should individuals consider this channel for, medical treatment of COVID or any cash crunch?
I think the first thing one should have had is health insurance in COVID. Now, health insurance obviously is your personal health insurance, which you will own in your name for the rest of your life. That should have been there. Secondly, you have your corporate insurance. So the company you're working for should have an insurance package that covers COVID. So you should get your hospital bills covered through that. Now, assuming that that insurance has certain deductible which you need to pay out of your pocket, or God forbid you don't have that insurance, then you come to looking at a COVID type of loan. I think a lot of the PSBs are offering it. The loans are being offered as subsidized rates. They're part of the credit guarantee scheme that the government is offering. But one thing which I want people to be aware of, Mubina, is typically this is being offered to existing account holders of the PSB. So you typically have to be an existing account holder. You should be, eligible for that loan. To check whether you're eligible, you need to log into your mobile app, or you need to go to the website of the PSB, and you need to check your eligibility. So if you are eligible, right, and you are an existing salaried holder of that PSB, I think the loan is available at low rates, and you should consider it as something which is a last resort. So firstly, you should have had your health insurance, either personal or corporate. Second, if you don't have that, you should have an emergency fund. If not, then as a last resort, if you're eligible, take the COVID loan from the PSB. But keep in mind, right, repayment is always there. You've got to plan your EMIs. Just be aware that it is an obligation you'll need to pay off in the next few years.
Oh yeah, absolutely. Remember, when you're taking on a personal loan, you're taking on yet another debt obligation, and that too at times when your income is either stagnant or perhaps even dipping. Adil, we leave it at that. Thank you so much for joining us today on the Money Show, and helping our investors and borrowers alike understand what should be their next move.
Thank you.